we kind of started seeing what are the chances that foreclosures are going to come back. Welcome back, everybody, to another episode of an Investor's Journey podcast. I am your host, Jonathan Barbera, and I wanted to talk about Are Foreclosures Coming Back? Right? There's a lot of us included. We're waiting to kind of see what's going to happen, to see what we're going to do with our marketing, to see where the leads are going to come from, and all of that. And in doing so, many of you have seen it. I'm going to link it below and also on the video. But we do a market update every month, and we put it out for free for you guys. And in that market update, we try to look at a lot of other things, right? And so part of that market update, we actually have a lot more data that we compile for ourselves, for our business, that we just don't put out because it's a lot of data. But in looking at all that data, we kind of started seeing what are the chances that foreclosures are going to come back. So we wanted to go ahead and share that with you guys. So first, I want to throw some stats at you, some numbers that we've been seeing, and then I'm going to wrap it all in to show you what we're thinking as far as foreclosures coming back or not, what types, and what to expect. So right now, we are at record high unemployment, right? Just from what I've saw recently, we've crossed over 40 million people file for unemployment. And they're projecting this is going to go well above 20% unemployment. And that's very bad. That level of unemployment is really, really bad. There's a lot of businesses that have already shut down their doors and they're not coming back. A lot of big companies, JCPenney's, I think J. Crew's, another one, have been filing for bankruptcies. And they're closing down a lot of stores. Gold's Gym closed down a lot of stores. So this is bad, right? But these are big stores that employ hundreds of people, that those people are no longer going to be working on top of everything else that's been going on. So unemployment is high. There's about 9% of homes are currently in forbearance. And we've talked about forbearance before. Like we said before, forbearance, people don't understand how this works. People think that forbearance is forgiveness, and it's not. Forbearance means that they're just allowing you to make either a small payment or even no payment at all for a few months. But that doesn't mean it's forgiven. What it means is that at the end of those few months, the full amount that you haven't paid is due. And that's where it's going to screw over a lot of people. Now, there might be a chance we're thinking that the government is going to come out with some regulations where they're going to allow people to add it to the back of the loan or do a loan modification or many other things to help them out because they don't want to increase foreclosures. But we don't know, right? So that's something that if you have somebody that's doing this, they need to be very conscious and aware that this may happen. And at the end of these months, they may be asked to pay the full amount right then and there, including that month's mortgage. So be very careful with that. So already 9% of homes are in forbearance. The Fed is buying mortgage-backed securities. Now, mortgage-backed securities is pretty much what caused the 2008 financial crisis, right? It was a huge scam going on in that. Now the Fed is offering to buy it, so banks loosen more their restrictions, but they're not. Banks are more worried than ever. They're very concerned. So they're making the restrictions a little bit tighter and making it a little bit harder for more and more people to qualify for loans. So this is going to affect the real estate market. So the bank restrictions are going up. We're already starting to see some rent reductions. So if you saw the market update, I believe in San Antonio, we're down 0.3%, not much, but it's important because we are in April. This is the biggest problem that I want to be clear with all this data. Real estate is not like the stock market where you see a tick, day to day, hour by hour, minute by minute. Real estate is a lagging indicator, right? So real estate is months behind on what the data is for right now, for today. We're not going to know today's data until a few months from now. So this is all data of when things started to go bad, right? And it already is bad based on that data. So you could just imagine as things keep progressing, it's only going to get worse for real estate. So rents have already been down. Um, and one thing to keep in mind is I was reading a Redfin article. They said over 50% in April, 50% of sellers have backed out year over year. So from last April to this April, over 50% of sellers backed out in April, and then only 24 backed out in May. So it seems like in May, some sellers came back on the market. April was understandable. They were kind of scared. They didn't know where everything was going. May, they started coming back on the market, testing the waters and all this. But there is a higher buyer demand. And the buyer demand, how they calculate it, is pretty much people interested in seeing a house, people that have applied for mortgages and things like that. That's what they gauge as interested buyers. So that's gone up. And selling is selling just as fast as houses did before. So this is all based on Redfin. I'm going to put all these links also on the description so you can check out the articles and the data yourself. But it's very interesting to see this because you're having low supply and high demand. So technically, that always pushes for prices to go up. So as we saw in San Antonio, medium sales prices did go up by 6.5% last month. So that is very interesting because we're having rents come down, prices are going up, not very investor friendly, all right? When I left New York, it was because of that reason. Prices were really high and rents were really low. So it's not very investor friendly at those ratios. And that's kind of what we're seeing right now. So we're paying close attention. But here's the important information from all of this is the average homeowner, and this was done back in March, had at least 60% of equity in their home. And about 40% of homeowners own their homes free and clear. So why is this important? Because with all this that's going on, even if they can't make their mortgage payments moving forward, it's very hard for them to fall into foreclosure because they have so much equity. You understand? They can still put the houses on the market, even at a discount, and sell them, and not only pay off their mortgage, but maybe have some money themselves to walk away. This is very important. This is not the 2008 financial crisis, and this is where a lot of people are getting confused in real estate because they're trying to compare it to 2008. 2008 was pretty much a housing bubble that burst, right? It was, you all heard the expression, if you can fog a mirror, you would get a loan. There were people getting loans under their dog's name. I mean, that's just insane. Nobody was checking anything. And that's what caused 2008, right? Anybody and everybody can get a loan. Loans on houses they should have never been able to afford. But this hasn't happened right now. Right now, people have equity in their homes. Home values, before the corona happened, we're in a very strong market. So there was a lot of appreciation. People have had equity in their properties. So there's a lot of people right now sitting on a lot of equity. So what that means is that you're not going to get a flood of foreclosures like we did back in '08, right? So in '09, 10, 11, there was a ton of foreclosures. I got here to San Antonio in, I think, 2012 or 13, and there was a ton of foreclosures. But that wasn't the case. That's not the case right now. Right now, there's a lot of people. And as you see, there's a huge demand of buyers right now. So you have a lot of demand of buyers and you have people with a lot of equity. It's not going to be very hard for them to sell their homes. So don't expect a huge flood of foreclosures on the market, and especially not a huge flood of foreclosures that make a lot of sense. What foreclosures we do anticipate are going to be the people that probably purchased a home in the last year to 3 to 5 years, maybe, all right? Depending on the area of town that you're in. Some areas haven't appreciated all that much. So those people we anticipate may have to go into foreclosure because, I mean, we saw people buying houses with jobs that were on shaky ground already, and we know because of this crisis, they've lost their jobs. So there's going to be that level of foreclosures, but on those deals, there's not much margin in there. So the best strategy for a lot of those is going to be a short sale. And you do a short sale when somebody pretty much owes either what the house is worth or more than what the house is worth. So they can't sell it on the retail market because nobody's going to pay over retail value. And they're going to have a large savings in order to eat that difference, or they're going to have to do a short sell. So I did do an interview last week with Angie Francis. She's the broker of StepStone Realty. I'm going to link on that as well so you can check that out. And she talked all about short sales. Now, I do believe short sales are going to come back. I do believe short sales are going to be huge because of this reason. There's a lot of people, this level of unemployment, a lot of those people got loans very recently. And those are the people that I think we're going to see in foreclosure because they're going to have houses that they're going to be willing to walk away from. So somebody that has 60% equity or 40% of the homeowners that are paid in full, their houses are paid off, it's going to be very hard to get them to walk away from their home, right? Because they have a lot of equity. Why are they going to walk away from that? They're just going to do whatever they need to do, and they're going to sell it. Now, what's interesting with that premise is we could see a bigger price drop in real estate because of that. Because we're going to see a lot of more people, when they try to sell, they will discount their homes. And a lot of people will have to discount their homes because of the conditions of the home, because they need to sell rather quickly, because maybe they will be facing foreclosure soon. Whatever the situation may be, they will most likely sell at a discount from where the market is. So we kind of are anticipating in the coming year a price reduction on houses. So we are anticipating a small price drop, nothing major. I mean, these are just predictions, okay, guys? I mean, this changes minute by minute, and our opinions change minute by minute as new data comes in. But with the data that we have right now, we're not anticipating a 20, 30, 40% price drop. All right, we're not seeing anything that major happen. But we could see a potential of maybe 10% price drop in a lot of areas, depending on the home values. In San Antonio, the medium price home, I got to check again, but I think it's like around 240 around there. So if you're selling a home that's 4, 5, 600,000, you might see a bigger price drop on those houses, right? Because it's not that high demand price point. But the ones lower, under 250, you may not see that huge price drop. You might see, maybe 5% or so on a price drop over the next coming years. So it's not going to be tremendous, but you got to keep in mind, if you're flipping properties, don't flip with the hopes that the market is going to pull you out like it has been the past couple of years. And if you're buying a rental, keep in mind that, your rent to value ratios need to be a lot tighter because you might have to drop your rents. Maybe not, but when you have a level of unemployment as high as we're starting to hit that are higher than the Great Depression, that's scary, right? That's a scary level of unemployment. And you don't want a house to be sitting vacant just because you're trying to get an extra $50 a month. And a lot of you may need that extra $50 a month just to break even. So make sure they're not that tight, all right? We always want houses that cash flow at least 250 to 300 up. And that's including everything. That's including all fees, CapEx, property management, vacancies, everything. So we want that net cash flow to be at least 250 and up. So I recommend that you target things like that because then if the chances that your rents are going to drop 250 is huge, right? I mean, the chances of that happening, I'm sorry, not huge, very low of that happening because that's a ridiculous crash that we're talking about at that point. So that's kind of what we're seeing. So if you're waiting for foreclosures because you think there's going to be a flood like there was in 2008 or like what you heard before, I don't think we're going to see that. I don't think we're going to see those 2008 crashes. I think we are going to see a lot of short sales. We are going to see a lot of people selling for discounts. So you should be targeting, if you're trying to do your marketing and everything, keep that in mind. Keep in mind that you're going to have to be working through a lot of short sales. So if you're an agent, figure out how to do them. Watch that episode with Angie. And just start catching up on, subject twos, owner finance, because in a market where prices aren't going up, owner finance is really good strategy to have because you can sell the house and you don't have to worry about losing appreciation because there isn't any. So, get brushed up on all that. We did also an episode with Dan Francis at the beginning of the tips with the pros, and he talked about owner finance. He does a lot of that. Also, an interview with Sam Madrid. He talked about owner finance. I think he has like 200 and something properties that are owner financed. So take a listen to those. Reach out to those people. They're going to be able to help you out and guide you in a better direction as to where all these things are going. So that's it from us. That's kind of what we're seeing with everything. That's the data that we have. And as more data comes in, as we see other trends and things that we are pivoting to, I'll be sure to go ahead and post it and share it with you guys so you can see what it is that we're seeing, what we're doing, and you can make your own decisions, all right? So remember, all the links are going to be below. You're watching on YouTube, hit that like button. That helps us out a ton. So make sure you like us, share this, help us out, get the word out, help investors be more educated. That's really our goal with this, is we want our investors in this community to be more educated. We see too many stupid investors doing stupid deals, and they're losing a lot of money, or they're causing other investors to lose a lot of money. Let's not do that, all right? Let's spread the knowledge. Let's help each other. Let's make sure that this industry becomes a good, credible industry to be in. All right, so I hope you guys are enjoying this. And if you have any questions or anything, make sure to reach out to us. And I will catch you guys on the next one.